Myself, Dr. P.T. Gandhimadi, Head and Assistant Professor of Commerce Computer Applications, V.V. Perumal College for Women. Welcome to YouTube channel. In this video, we have to discuss about the valuation of goodwill in corporate accounting. What do you mean by goodwill? Goodwill, it is nothing but the value earned by the firm. That is, present value of the firm's anticipated excess earnings. The good name of the firm. It is the reputation of the business. Definition given by the Institute of Chartered Accountants of India. Goodwill is an intangible asset arising from business connections or trade name or reputation of an enterprise. If the company runs a long time, if the company earns a goodwill. Then methods of valuation of goodwill. In valuing the goodwill, there are three methods has to be followed. Average profit method, super profit, then capitalization method. What do you mean by average profit method? Normally, the profit is calculated by adding 3 or more years, 5 years or 3 years profit divided by 3. So, the formula is first year adjusted profit, second year and third year divided by 3. You have to divide the number of years, that is if you take 5 years divided by 5. Then goodwill, the formula is average profit into number of years of purchase. Then what are the items to be taken into account for calculating the adjusted profit? What do you mean by adjusted profit? In one particular year, there will be the recurring items and non-recurring items. What do you mean by recurring items? The recurring items are occurred regularly, that is day-to-day expenses or anything. Non-recurring means the expenses or income which is not earned regularly. That is, for example, if it is a speculation loss or loss of stock on fire, it is a non-recurring loss. Just like that, non-recurring expenses, that is the expenses which is not to be made in future. For example, if a company wants to install a machinery, then it has to pay the carriage inwards, then other items with relate to the machinery. This is the expenses which is not a regular expenses. That is the non-recurring expenses. Recurring income, if the company earns a profit regularly, for example, if they invest in a investments which is related to the trading, for example, debentures, if it is invested in the debentures or other things, then it earns a income. This is if the investments is related to the trading, it is taken into account here. But if the investment is not trading, not related to trading, then it is not considered here. You have to reduce it. So, we have to add non-recurring losses, non-recurring expenses, then recurring incomes. Less. We have to less the items which is non-recurring income, non-recurring profit, then recurring expenses. The best example for recurring expenses is if a company wants to make an insurance for their business, then in future they have to compulsorily pay the insurance premium. This is the recurring expenses. Then income from non-trading asset. Non-trading asset means if the investments are made in other investments, government bonds, NSE, this is not a trading income. So, we have to exclude this. This is given in this table, that is adjusted profit. We have to take into a particular year profit, then the items related to the particular year has to be added. Then if there is an adjustment with regard to particular year and that particular year, all the adjustment has to be made. If it is a common, that is already I told that the income from investment in non-business, that is to be deducted from the adjusted profit. Then super profit method. The steps for calculating the super profit is, first we have to calculate average maintainable profit, that is average adjusted profit. Then we have to calculate average capital employed. Then after that we have to calculate normal profit, then super profit, then goodwill. Let us see one by one. average maintainable profit, just like that the average adjusted profit. The same procedure we have to follow. Then with regard to the average capital employed, we have to take all the fixed assets and trading assets, then current assets, then if we need to less the depreciation in fixed assets, we have to reduce it. Then we have to take outside liabilities. What are outside liabilities? The company has to pay the amount to the outsiders such as creditors, debenture holders, then government, that is taxes, then outstanding expenses, bills payable. These are all the outside liabilities. We have to reduce the outside liabilities from the total assets. That is called capital employed. If there is a current year profit is there, we have to reduce half of the profit from the capital employed. It is an average capital employed. If there is a no current year profit in the problem, we have to take the capital employed as the average capital employed. Then this is the liability side approach. In the previous slide we have to see asset side approach. In this we have to taken into account as the amount which is or used specially to the equity shareholders, equity share capital, preference shareholders, preference share capital, reserves and surplus, profit and loss account, then profit on revaluation of assets and liabilities. What do you mean by profit on revaluation of assets and liabilities? If you value the assets, now the value of the asset may be increased. That increased amount is called profit. Then we have to reduce the goodwill, then non-trading assets, which are all the assets not related to the business. Already I give an example, the investments in government bonds. So we have to reduce it. Deferred expenditure is also reduced. What do you mean by deferred expenditure? The expenditure which is incurred for a lump sum and the benefit is derived for long period. The best example for the deferred expenditure is the advertisement. For creating an advertisement, the company spent heavy amount, but the benefit is derived for more than 5 years. So it is a deferred expenditure. That is also to be reduced here. So just like that, we arrive capital employed. From the capital employed, half of the profit of the current year has to be reduced. After that, we have arrived average capital employed. Then normal profit. How do we calculate the normal profit? The normal profit formula is average capital employed into normal rate of return. What do you mean by normal rate of return? The rate of return earnings, that is rate of earnings expected in the same type of industry. For example, if we are running a textile industry, we have to take the rate of return in the textile industry in the same region, same area. Then super profit. Super profit is nothing but adjusted average profit minus normal profit. So we arrive the super profit. Then goodwill, the formula is super profit into number of years of purchase. Number of years of purchase means the company, how many years they have to improve that capacity. So number of years purchase is given in the problem. Thank you.